Hey, welcome. Today we are tackling a really big topic, one that's probably on every investor's mind at some point. How do you build a portfolio that can actually stand strong, even when the economic winds really start to howl? We're going to dive into a playbook designed for exactly that, for resilience. So let's just start with the big question right off the bat. Is your portfolio ready for a downturn? Look, recessions are an inevitable part of the economic cycle. They're unnerving for sure, and while nobody has a crystal ball, we can absolutely prepare. The goal isn't to be perfect, it's just to be ready.
And this, right here, is the key mindset shift you need to make. We're not aiming for zero losses. That's just not realistic. What we're doing is building a kind of financial shock absorber. The whole point is to lessen the blow of a downturn and, this is just as important, be in the perfect position to bounce back when the market inevitably turns around.
Okay, let's get into the mechanics of it. We're going to start with the absolute cornerstone of any strong investment strategy, especially when things get a little choppy out there: diversification.
You know the old saying, don't put all your eggs in one basket? Well, this is basically the financial version of that. The core idea is simple. When one part of your portfolio, say stocks, is having a really tough time, another part, maybe bonds, can act as a ballast, helping to keep the whole thing a lot more stable.
But true diversification goes even deeper than that. It's not just about mixing stocks and bonds. It's about spreading your investments across totally different industries. That way, a downturn in tech, for example, doesn't sink your entire ship. And it's also about spreading them across different countries, because not all economies move in lockstep. Each one of these layers adds another level of protection.
So if diversification is all about where you invest, the next logical question is, what do you invest in? Well, during a downturn, the answer is often pretty simple: the essentials.
Okay, so there's a huge difference in how different parts of the economy perform in a recession. When times get tough, people cut back on what we call discretionary spending. Things like fancy new cars or big vacations. But what don't they stop doing? They don't stop buying groceries or paying their electric bill. These are the defensive sectors, and they're built on these essential needs, which gives them a really solid foundation of stable demand.
And here are some real-world examples. Just think about the companies that provide things we can't really live without: food, water, medicine, and yeah, in today's world, you can definitely add internet service to that list. These are the kinds of businesses that tend to have much more predictable revenue, no matter what the broader economy is doing.
And this brings us to another important distinction. Those high-flying growth stocks, they often get their sky-high prices based on promises of huge future earnings. But in a recession, that future suddenly becomes very, very uncertain. Value stocks, on the other hand, are typically mature, stable companies. They can be a real safe harbor in a storm.
But it's not enough to just pick the right sector. You've got to look under the hood at the companies themselves. So the question is, how do you spot a company that's really built to last through the tough times? When you're looking at a company's books, what you're really searching for is financial health. For instance, companies with low debt aren't as vulnerable if interest rates suddenly spike. A big pile of cash on hand means they can weather a slow period without having to borrow. And positive cash flow? That just shows the business is a well-oiled machine that's generating more money than it spends. That's what you want to see. This brings us to a really important point about dividends. Now, getting a steady income stream is fantastic during a downturn, but a super high dividend from a company that's struggling is a major red flag. The key word here is sustainability. You want to find companies with a long, proven track record of being able to pay their shareholders, not just some flashy number that might get cut next quarter.
Okay, so we've covered what to own. Now let's talk about the most important variable in the equation: you. Because in a downturn, your actions, your discipline as an investor, are every bit as important as what's actually in your portfolio. This strategy is one of the most powerful ways to take emotion completely out of the equation. By just investing a set amount of money on a regular schedule, say every month, you automatically end up buying more shares when prices are low. That's exactly what you want to be doing during a downturn. It completely takes the guesswork out of trying to time the market and actually turns volatility into an advantage for it.
All right, here's another disciplined strategy in action. Let's say this is your ideal portfolio. This is your target, based on your own goals and how much risk you're comfortable with. A nice, balanced 60-40 split between stocks and bonds. But, of course, the market never stands still. Let's imagine stocks have a fantastic year. Well, what happens? Your portfolio will naturally start to drift away from your original plan, just because the value of your stocks is growing way faster than your bonds. And then,
All of a sudden, this is what your portfolio looks like. Without you doing a single thing, it's become more aggressive and, frankly, a lot riskier than you originally intended. You're now way more exposed to stocks right after they've had a huge run-up.
And this is exactly where rebalancing comes in. It's the disciplined act of selling some of those stocks that did really well, selling high, and using that money to buy more of the underperforming bonds, buying low, to get back to your original 60-40 target. It is a simple, almost automatic way to lock in your gains and buy assets when they're on sale.
You know, all of these different strategies, diversifying, picking strong companies, being disciplined, they all lead to the single most important rule for navigating a recession. You have to maintain a long-term perspective.
Seriously, when in doubt, just zoom out. History gives us such a powerful lesson here. It shows us that every major downturn in modern history, no matter how terrifying it felt at the time, was eventually followed by a recovery and then new all-time highs. Patience is consistently and handsomely rewarded.
So the most crucial point is this. The single biggest mistake an investor can make is to panic. Selling when everything's down, that turns a temporary paper loss into a permanent, real one. And it almost guarantees you'll be sitting on the sidelines when that powerful rebound finally happens.
And that brings us to the end of our playbook. The real goal here is to give you a sense of confidence and control. So, looking at all these strategies, from diversifying your assets to disciplining your actions, I'll just leave you with this question to think about. What's one change this playbook inspires you to make in your own approach?